G'day, it's Jonathan Bays and this is our October investment market update. This month I'd like to address four themes that we think are impacting portfolios. One is higher bond yields in the United States. The second is a potential peak in corporate profit margins. The third is the theme that I've addressed a few times before, which is a weakening in Australian housing markets. And the fourth issue, again something I've addressed before, is a potential for a change in federal government in Australia next year. The big one, firstly, that came about last week was the rise in US bond yields. We've had a push to 3.25% on US 10-year bond yields, which is the highest we've seen since 2011 and indicative of a US economy that's in really strong form. We also saw a really big move on the wage front last week from Amazon, which many of you will have seen. They elected to move their minimum wage up to $15 an hour, which is about a 15 to 20% rise for the 350,000 workers that they've got, and the 100,000 seasonal workers that they're going to employ as we go into the Christmas retail season. We're starting to see, as I say, wage pressure come through. On top of that, we've seen a pickup in oil prices, which is also adding to cost pressures in the US, and as a result we've seen bond yields pushed to the highest level in 7 or 8 years, and that has implications for asset price valuations. The second thing that we think is starting to change and potentially investors should keep their eye on is a peaking in corporate profit margins. And the third thing, which is starting to unfurl, which I've alluded to in recent months, is the slowdown in housing and the slowdown that is happening in construction as well. It has ramifications obviously for Australia's economy, it has ramifications for investment. Building approvals last month were down 14%. The big focus was on apartment approvals, which are now running at half the level that they've averaged in the last 5 years. But importantly too, private dwelling approvals are down about 5%. On the average over the last 5 years and virtually near the 5-year low. This is going to have a knock-on effect for construction work in about 6 months' time. It tends to be the lag that it takes, and that'll have an impact on construction jobs, which is pretty important, I guess, because we've seen very strong employment in Australia, and a lot of that has been driven by construction activity. So that'll start to weaken off. And will have an impact, I would imagine, on consumer sentiment as we go into the end of the year. Obviously, the fall in house prices is having a bit of an impact as well, and I would expect that to continue. House prices are now down year on year at a national level. In certain parts of Melbourne where I am, prices are down 10 to 15% already on where they were a year ago. And I can't see that changing anytime soon, particularly given the impact of the Royal Commission on credit availability and the like. And I would imagine the spring selling season that we're going to see is going to be quite disappointing. A fortnight ago, auction clearance rates nationally hit their lowest level since 2012, under 50%. And as I say, I can't see things changing, particularly with the uncertainty of a federal election coming up in May next year. The fourth thing that I guess I want to flag up, which again I touched on briefly, but something that investors really need to start considering, is the potential for government change here in Australia in May next year, and the impact that that'll have on portfolios and the way we structure them. I've written about it on a couple of occasions, certainly urge you to take a look at the note, but we'd be happy to help. We've tried to get portfolios starting to reflect a potential change. We've alluded to the tax changes and the difference in policy between the two parties. Negative gearing is something that's been discussed, and capital gains discounts another issue. But if we were to see a Labor Party come to power early next year, it will have an impact on how we value and how we invest in dividend-paying companies and tax-affected securities like hybrid securities. And it's important that we start to move the portfolios in a way that doesn't leave us too at risk, if you will, of a change in tax policy. The other thing that I guess has the potential to change under a Labor government is if we're diminishing the value for retirement investors anyway of franked income. We probably actually appreciate upwards those companies that provide strong capital growth. And I think if we go down that path and we see the tax changes affected by Labor, you'll see a continued shift to international equity markets where capital gain and capital growth, is more of a focus. And you'll see a bit of a shift into small caps as well, where growth is again at a premium. This month we're pleased to have Tom King, who's the CIO and founder of the Nanuk New World Opportunities Fund, which is a great international equity fund that's outperformed its benchmark in recent years, focused specifically on energy efficiency and environmentally sustainable technologies, and a fund that we think you'll find really interesting to hear about.
Hi, my name's Tom King. I'm the Chief Investment Officer at Nanuk Asset Management. Interestingly, we're seeing a trend away from government subsidy and regulation. Now, part of that's being driven by President Trump in the US wanting to dismantle Obama's environmental regulation. But what we see on a much wider spread basis is sustainable technologies getting to the point of being economically viable without subsidy or regulation. We've seen a number of the major oil and gas companies around the world investing in things like renewable assets, in electric vehicle charging infrastructure, in car sharing businesses, because they recognise that the world is moving in that direction, that their legacy businesses are likely to be in decline. A very interesting announcement by Macquarie Bank, who've committed to help financing a very large renewable project in the Pilbara called the Asian Renewable Energy Hub, where a number of companies in joint venture are planning to build 11 gigawatts of wind and solar generating capacity to provide cheaper electricity in that part of the world and potentially sell it north into Asia. And to put that in context, Australia has about 50 gigawatts of operating generating capacity in total today. I think anyone investing in global equities at this point in time needs to be very conscious about economic cycles and market cycles. On an historic basis, global equities aren't particularly cheap, and parts of the market are relatively expensive. So the US market's performed extremely well over the last few years. On the flip side, as I said earlier, we've already seen some significant declines in parts of the global equity universe that are starting to present opportunities now that, irrespective of what happens in markets in the short term, over the long term should give us opportunities to make good returns for our investors.